Welcome once again to a market microstructure video. In this circumstance, we're going to look at an interesting topic, and that is we're going to see how the opening price gets determined in an order-driven market like the New York Stock Exchange. Okay? In other words, markets close and then trading opens the next day. What process occurs that results in the opening price? Well, all day long while markets are trading, with the exception of the opening price, we have what's called a continuous bilateral auction. Orders to buy and sell, that's the bilateral part of it, arrive continuously, okay? And of course, it's an auction. An auction is where buyers and sellers meet, okay? But at the open, since it's the first price of the day, it's just that, it's the first price of the day, and we're going to see how that gets determined. Now, in short, it gets determined by looking at the limit order book. And who does this? Well, for a New York Stock Exchange listed security, it would be the specialist, okay? So let's say the specialist arrives. Now, the specialist, we're going to pretend is a person. Of course, it's actually a firm, an entity with lots of people and computing power, etc., etc. But let's say this is the limit order book that the markets open, the NYSE opens at 9:30 Eastern time, 6:30 our time. And let's say the specialist arrives and, round about 9:25 or 9:29, the specialist peeks and he sees this. Okay, for this stock, at 23.12, there's a total interest to buy of 600 shares. At 23.11 specifically, there's 500 shares interested in buy. 600 shares at 23.12, 500 shares at 23.11. At 23.10, there's 1,000 shares interested in being purchased. You know, it could be one person wanting to buy 1,000 shares or 10 people each wanting to buy 100 shares. Doesn't matter, but 1,000 unique to 23.10, 300 shares at 23.09, 700 shares at 23.08, all the way down here to 800 shares at 23.03. That's the buy interest in the limit order book. Those orders didn't execute because the market was closed. They may have been placed 8 weeks ago, or 2 weeks ago, or 3 days ago, or maybe they were placed overnight or 2 minutes ago. But they're in the limit order book right now. If they were placed in the past when the market was open, they obviously never executed. Now let's look at the sell side. Excuse me. At 23.03, there's 400 shares that specifies that price. At 23.04, there's 700 shares. At 23.05, there's 600 shares that someone wants to sell. At 23.06, 1,000 shares that one person or many entities combined, each in total, their interests total 1,000 at a price of 23.06. At 23.07, maybe one person wants to sell 50, another person wants to sell 60, and somebody else wants to sell 90, but the total is 200. And so on, all the way down here to 23.12, 1,100 shares available at that price. Now I have the limit prices for the buy in order from the most aggressive buy limit price to the least aggressive. And on the sell side, in the limit order book, we have the prices listed from the most aggressive sell price. An aggressive sell price is, if you want to sell something, you're willing to take a low price. That's an aggressive sell price. So this goes from low to high, okay? So this is what we start with. So we're going to figure out what the opening price has to be. You'll remember from economics, specifically microeconomics, that if we have competitive markets, the price at which the market demand curve and the market supply curve intersect is the equilibrium price, and the quantity that you read off the horizontal axis is the equilibrium quantity for that market. And if you think about it, that price is the price at which the most number of units of that good will trade. And the same thing is true here. If we come up with the best opening price, we're going to come up with the opening price that's going to allow excuse me, the largest number of shares to trade. Well, down here, we can see a chart of the cumulative columns of the demand, the buy interest, and the sell interest, okay? And of course, the blue is the demand interest. You can click on the curve, and it'll show you where the data came from. I'll explain this in a second. You click on the red curve, it'll show you where the data came from. And now what I did over here, which will facilitate your understanding of this graph, is I put the prices in this order, and then I put the cumulative buy quantities associated with this price and the cumulative sell quantities associated with that price here. Again, these are the cumulative quantity columns I'm using. And because remember, the prices are in different orders here, I put them in the same order, and I use cumulative quantities, and then we can get these two lines. And the intersection is that right there, except we note that there's no point right there. There's a point here that really exists, and a point there that really exists, but there's no actual point at which quantity demanded cumulatively equals quantity supplied cumulatively. So we're going to think about how that is remedied, how that problem is remedied. So we create this column here called excess demand. So cumulative demand 6,300, cumulative sell interest 400, so excess demand is 5,900. Here 5,500 demand, 1,100 selling interest, the excess demand is 4,400. It's this minus this. Of course, when you get down here, I'll jump to this one, when demand at 23.12 at that price, cumulative buy interest of 600, cumulative sell interest of 5,600, excess demand is negative 5,000. Well, that would be also considered excess supply, of course. But we'll just use it, we'll look at it here as negative excess demand. And here's the big thing to know. The specialist, generally speaking, has to step in and make a trade to facilitate opening. And how this happens is as follows. The specialist calculates excess demand at each price, and then he looks for the value of excess demand that is closest to zero, okay? And the number that's closest to zero here is minus 300. So 2308 is going to be the opening price. But excess demand since it's negative, means that supply interest at 2308 cumulatively exceeds demand interest at 2308 cumulatively, okay? There's negative excess demand or excess supply. So what this means is in order for the opening price to be 2308, the specialist will have to place a buy order for 300 shares. And when the specialist does that, then we get an opening price that will clear the market. Now think about what that does. If the opening price is 2308, that means, I'll go over here, anybody who was willing to pay 2312 is going to get what they want, and 2311, 2310, and all of these quantities, all of those are going to execute, okay? So we can kind of think of these trades as no longer being in the limit order book, okay? And from the sell side, if the opening price is 2308, someone who is willing to sell at 2303 is going to have their order execute. By the way, at 2308. 2304 is going to execute at 2308. 2305 is going to execute at 2308. 2306, these are going to execute at 2308. So all of these will effectively disappear. And then what we're left with then are these two prices, 2307 and 2309, and guess what they are? That's right, those are the bid-ask quotes 1 nanosecond after the open. So this is, I think, a neat spreadsheet that allows you to apply your knowledge of microeconomics to the determination of the opening price on an order-driven exchange like the New York Stock Exchange. And Max, shush. and it helps you really become comfortable with what's going on there. It's a really neat application of your understanding of microeconomic theory. Remember, after the opening price, we have occurring a continuous bilateral auction. But the opening price is determined via something that's called, the name of the spreadsheet, a single price call market auction. One price exists, in this case it was 2308, and a call market means there's a certain time when someone will decide what the equilibrium price is. And so the opening price on the NYSE is determined by a single price call market auction. A single price call market auction. One more time, for the rest of the day, we have what's referred to as a continuous bilateral auction. And I hope you enjoyed this. Thanks for watching.